All right, everybody. So today I'm going to do a lesson on basically the key elements of trading, and all successful traders have this. It's either written down or it's in their head after years of experience. But this really, you'll come to this conclusion after a while. All right, but it's very helpful if someone tells it to you way in advance. All right. Shit. All right. One second. All right, so in these are the elements, and then you can put it together and see which ones are missing, and work on them. So the first thing is always breaking it down into two pieces, two categories. There's the planning, and then there's the execution. What you'll hear most of the time is that there's analysis and then there's execution, but it's a little more deeper than that. I'll break it down into two pieces, planning and execution. I'll go over execution first, and then I'll go over planning. So basically, there's planning and execution. In execution, which I'll go over now, you have market selection. Market selection, like the term says, is just selecting which markets you're going to trade. How that's done is multiple ways, and whichever way works for you, you pick that. So you'll see some folks, they'll be taking lists of new highs, new lows. It could be 3 months, 6 month, or 52-week highs and lows. They sometimes do it based on that. Others will do it based on momentum scans. So they'll run various scans and see what's has the most momentum, because they're momentum traders. Third, a lot of day trading stocks, folks that do that, they'll do it based on markets that are gapping or their percent change. Finally, fundamental traders will be taking a look at earnings and catalysts and seeing if if any catalyst exists, because it's a fundamental changing of the price, like the asset is being repriced based off of earnings or catalysts. Others will do it based on relative strength. Whichever approach you use, the idea here is to be able to select a market based on some criteria. So you're selecting a market to trade based on some criteria. And these are just some example criteria. There are others as well, but this just gives you an idea. And the more important point is you need to have a way of selecting which markets you're going to trade. All right, that's the skill. The skill here is a skill of market selection based off of some criteria. That's the skill that you have to ask yourself, do I have this? Or others will just trade the same market every day, all day. So, scalpers, for example, will just say, okay, I'll pick the ES and just try to trade that. So that's also an approach. They've selected a market, right? It's just one market because they're selecting it because there's volatility and liquidity. So whatever it is that you do, it's based off of market selection. Options traders will typically stick to certain stocks. For example, a lot of options traders are right now, they're trading Tesla either on the short or the long side, or they'll have just a couple of markets like Apple, Meta, and whatever, because of their liquidity, and they can trade it intraday. Someone else may just take a look at ATR. So the idea again here is market selection. Let's move on to the next one, which is where to find trade. This you have to ask yourself, have you answered this question, and have you acquired the skill of where to find trades? So typically these are the areas where you find trades. You have support resistance levels, which are just, everyone knows support resistance, so I'm not going to explain it. Others will use high volume nodes or low volume nodes. These are the profile traders. They will use high volume and low volume nodes, because they're always trading around value and the POC and stuff like that. So high volume node, low volume node, POC. Others will use some type of moving average to where to find trades. They will use a moving average and try to look for a reversion to the mean, or they'll use VWAP. Finally, the fib traders will always use fib levels, like usually that 68% level. They're very it's almost crazy about it, but they're big on these fib levels. And then finally, you have other traders that will use supply and demand zones and order blocks and supply and demand zones. It doesn't matter. You have to ask yourself, have you completed this? Where to find trades? If you're asked, where do you find trades? Can you say which one of these? Or maybe you have some other approach. If you don't, then there's the gap in your trading. You don't know where to find trades. Because without answering this question, you'll be totally lost. You won't know where to focus, and you can't even proceed any further. What you don't want to do is have other people in a Discord room or in a chat room giving you a level or like a certain price. That is usually a sign of that there's a problem. So you want to be able to do this yourself. Otherwise, trading just doesn't work. Because if you haven't answered this, you don't know how to execute. So again, the idea here is support resistance, or if you're using a profile method, HVN, LVN, whatever approach you use, this question has to be answered. Market selection, and then where to find trades in that particular market. And then marking those areas to identify the next step, which is what is the setup that you're going to use, that you're looking for. That's what I should say. What is the setup that you're looking for at support and resistance, at the HVN or LVN, at the VWAP, at the 60%, at the supply demand zone. So this is the next step. What is the setup? So for some, they will use spring and up thrusts, right? It's notorious to use spring and up thrusts at support and resistance levels. They just go hand in hand. Others will use flags. There's some bull flag or bear flag or some coil or apex or some tightening, some contraction or some squeeze indicator. I should have also written diversions. A lot of traders at support resistance or wherever it is where they're looking for trades, they look for diversions. They will look for momentum diversions. So they look for those higher lows and higher highs. Even though the market is at a level, they're looking for those higher lows or the lower highs. So diversions also is the setup. So they'll be looking for springs up thrust. Are you looking for flags or certain bullish bearish formations? A lot of white coat traders will look for a change of behavior or a change of character, whatever you want to call it, plus a low volume pullback at that particular level. So what is it that you're looking for? Others will look for contraction or squeezing there. Others will look for wicks. They'll look for those levels. They'll look for wicks, started wicking at that area. And then finally, I'll just put this here. Diversions. This is very common for diversion-based traders. They always look for, and there's others as well. For example, at that level, they'll start looking at order flow tools, and they'll see, okay, is the volume coming in, okay, or is the volume tapered off? If the volume is coming in and the price is not going down, there must be an iceberg, or they'll look for something or the other. I'm not saying one is better than the other. I'm just saying this is what you have to develop expertise and say, what is the setup, right? So what is the setup for you? Is it a spring or up thrust? Is it a flag? Is it some bullish bearish formation? Some will start taking a look at, their indicator and start seeing their momentum diversions there, or they'll look for that various contractions and squeezes and lots of things. Basically, they're looking for a setup. So you have to answer this question. After this, the question is, what is the trigger? All right, so what is the trigger for you to get in? The common one would be a breakout. So let's say you go to, It could be a breakout over the prior bar, meaning the higher high. So it starts wicking at that support level. It starts wicking, and all of a sudden you have this big green bar from right after the candle that wicked. So they're looking for a breakout. It could be a breakout of a prior bar, making a higher high, or a close above the prior high. It could be a swing high, a minor swing high that's breaking out above. Some will look for engulfing candles and say, okay, that's the trigger. What is the trigger? It's a big green candle or a big red candle. Some will just look for MA crossover and say, okay, at that, I want a trigger. What's the trigger? This MA crossed. Others will look for trend line breaks. They'll draw a trend line. It's at support, draw a trend line. It breaks the trend line, they go along. Others will look for a reversal bar. So that's very similar to this higher high, big green bar above the low bar. So it's basically a reversal bar. All right, so ask yourself, what is the trigger? So you got the market selection, where to find trades, what is the setup, what is the trigger? Now, this is the next step. The next step is your actual execution parameters, the stop, entry, and exit. All right, so the stop, most folks will put the stop at the pivot low or the prior pivot low. Others will use an ATR based stop, 1 ATR, 2 ATR, something like that. So a lot of day traders, what they do is usually use higher day, lower day stop, right? They use this all the time. High day, lower day stop, or ATR based stop, and say, okay, the day's ATR is this, when it shouldn't go to 2 ATR. These are pretty wide stops. Others will use if they see a big engulfing candle, they say, okay, it cannot close below that engulfing candle because then it's been invalidated, right? So that's your point of invalidation. So they'll say, below this big green candle, I'm out because the trade is invalidated because the engulfing did not hold. Others will do it based off of what? A standard deviation, just based off a standard deviation. So for example, if they get in at a moving average crossover, they'll get out 2 standard deviation below. Or they'll do it based on a percentage loss or a dollar loss. Percentage loss or dollar loss. Right? So they say, I cannot lose this much amount on any particular trade. If I do, I'm out. Or I cannot lose more than 1%. Right? And then finally, when you do get a trigger, how do you get in? Some traders will just get on the close of the bar. So they have engulfing closes, they long. Others will wait for a little bit of pullback and then they'll get in. Meaning after engulfing candle, you might have another candle which dips slightly below the close of the engulfing candle and mitigates or tests the prior bar high. And these guys will get in right after that. So there'll be some type of test after that trigger that you'll use as your entry. Others will just use a support and resistance test. All right, so it makes a higher high. I want to get in at the pullback that touches the prior high. And others will just, they'll have many other ways to enter. As I said, moving average crossover is just, the list goes on and on, right? So they might have a calculated risk amount. So they want it to pull back just enough so they're only risking X amount of dollars. And then finally, the exit. So what is the exit? The exit is typically based on R multiple, a prior support resistance level, or it could be based on being stopped out based on a trailing stop. So the low, the pivot low, the prior pivot low. Others may exit at a location, for example, in a high volume node or point of control. They want out at that area because they think the market's going to react because of all that volume at that particular level. And others may see a climactic move, a surge, and they may use that. So whichever, you have to have your exit parameters. So as you can see, I've broken down from market selection to where to find trades, to what is the setup, to what is the trigger. From the trigger, what is the stop, what is the entry, what is the exit. All of these are the basics. You have to answer these. And if you don't answer these, it's going to be a real big problem because you cannot be consistent. Because when you're trading, there'll be a lot of thoughts that are going into your mind, and it will not allow you to exercise discipline or be consistent and get consistent results. Because one time what will happen is you'll use this setup of a spring. The next time you'll use a flag setup. When you put your stop, one time you'll use the pivot low. The other time you'll use the bar low. The third time you'll wait for a certain dollar amount and basically lose a lot of money and then exit. So that's the problem. When you have answered these questions that I'm showing you here, when you've answered this, you can create consistency because you always know what to do next. This is the key. You always know what to do. You know what market, you know where to find trade, you know what is the setup, you know what is the trigger, you know where to put the stop, you know where to enter, and you know where to exit. When you have all of this and you've identified it, only then can it go on autopilot. And you can click, 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 click. And that's when trading becomes easier because you've answered all these questions. But in order to do that, you have to write it down. You cannot be it cannot be haphazard, and it cannot be done on the fly. You don't want the decision making done on the fly because it typically is influenced by how the market is behaving and your P&L. And that P&L can create a lot of pressure in the mind to do things that are inconsistent, getting you either stopped out early or taking profits early or doing something that you later realize, why did I do that? Right? So this is what you need to answer right here that I've put up here. This is what you need to answer. And as soon as you answer this, you start working on executing it. You might find a little bit of minutia, you know, okay, how exactly I enter, or maybe when I exit, I want 2 targets instead of 1. You know, I want to enter and I want to scale out, whatever. But you will have it under your exit criteria, right? Or you may say, I'm not going to exit at an amount until I get stopped out, so I'm focusing on the trail. Or you will say, I want to get out as soon as we go to a high value node, or at least 50% out and 1 runner, whatever. These are all exit criteria. They're all answering these questions. So you have to get this stuff answered. Otherwise, it just creates too much. Trading becomes hard. Why is it hard? Because the market is always trying to influence your thoughts when you're trading it by using your fear of loss and your fear of missing out. It is a tug of war. When you're profitable or not profitable, that fear of loss, it's constantly in play. And the FOMO is also constantly in play. So the multiple fears are constantly in play. If you don't have all of this written out, You cannot overcome those fears. The only way to overcome those fears is to know what to do and what to do next and focus on that. Otherwise, you'll be at the whims of the market's green and red bars, and it will be impossible to make money, and it will create massive amount of stress, and that can be very, very negative psychologically. Anyway, moving on to the next. All right, so now I'm going to enter the planning. Now, planning, first thing is you must have a trading plan. There are some folks, they don't have a trading plan, but they are far and few, and they actually do have a trading plan. It's just in their head after 20 years of experience. So they have it in their mind. But for the 99%, you must have a trading plan with the above mentioned execution details. You must have a routine. In my opinion, you have to have a routine. And then the risk parameters of sizing and the markets and the timing. Because as I explained, the 4 fears, fear of missing out, fear of loss, fear of leaving money on the table, and fear of being wrong. They are what you are engaging. You're engaging your own fears. And if you don't have a plan and know what to do and what to do next and focus on that, what do you think is going to happen? Your mind will automatically focus on the fears. And anyway, so trade plan must be written. Market timing, risk parameters, sizing, routine, and the above mentioned execution details. After that, if you're going to trade, you have to have a daily trading plan. The daily trading plan indicates what markets you're watching, the levels that you're watching those markets, very important. Otherwise, again, as soon as you see a green bar, you'll be interested, right? As soon as you see a big green bar, you say, oh, yeah, let me chase it. Why? Because FOMO is in play, right? FOMO, market makers will use it to get you in early and to get you out early. So understanding these things and how they, I'm not going into all of that, but that's why I'm just saying that markets and watch, levels in play, so you don't get sucked in. If you see many times before the test of the test the breakout, there's already a move. And I think it's called inducement. Some people call it inducement, some people call it whatever, but the foundation of such a thing called inducement is your fear of missing out. It is built on fear of missing out. So that's why I'm saying that you have to focus on the levels, your levels, and not really care if you get, what the market is doing at places that you're not planning to engage. All right, because it is you against yourself, but the market makers, they know your weaknesses in terms of the fear and the psychology, and they will try to take advantage of that. All right, you see it all the time. You see how many breakouts fail. You think that's coincidental? No, it's not. Anyway, so levels, and once you have your levels, you want to be anticipating behavior, meaning what is going to happen at that level. You should anticipate what should happen at that level. So let's say you have a support level, right? You have a breakout and you have a test at the breakout, and it's at that level. Now what you're waiting for, one thing could be a spring on the test of a breakout, or a spring at a low, support level, or upthrust at a resistance level. You're anticipating it. So anticipating behavior, knowing what to look for and where, that's what this is about. Finally, the execution details, which I've mentioned above, must be It must be on auto. Like you should know exactly where you're gonna put the stop, target, entry, and how you're gonna scale in, scale out, move it. All of that really important. All right, so you have a trading plan, but you have a day trading plan, and that day trading plan is just focusing on the markets that you plan on trading today, if that's what you want to do. All right, next is the date and time. Yeah. So this is trade logging. So you need this because trade logging is just, I took all these trades. This was the setup. This was the entry. This was the exit. This was the P&L. This is how you get metrics. This is how you identify mistakes. This is part of what goes into your journal. This is a reality check. All right. This right here is your reality check, because this is the data. Next is your market review. So what's the story? What's the story of the market that you're trying to trade? I can't tell you how important this is. This is so important. This is so important. A lot of folks will do this in a different way. They use what they call multi-time frame analysis. Right? That's what they do. It's called multi-time frame analysis. However it is you want to do it, you know, the story is that multi-time frame analysis telling the story, but the result of this activity leads into knowing your market and developing intuition. This is the edge. The edge is not those lines all over the chart. The edge is not a trend line, and it's not the support and resistance. It's not, okay, knowing this big volume here and little volume there. The edge is developed by doing this activity over time on a particular market, developing an intuition. Even Wyckoff talked about it when he talked about tapering. He said, you know, he wanted the student to develop intuition that results from, you know, spending many hours a day in front of a tape or a chart. So this is the edge. Intuition, market intuition is the I can't explain it other than call it intuition, but there's something to be said about this. If you don't review the market, a particular market, and you're just drawing like a line or doing the scan, you'll have more losses. I really believe that this is it's a major edge. And that's also why Wyckoff used something called a position sheet. He didn't just, you know, say, okay, this market has the most relative strength. You know, he used position because he was trying to figure out how much juice the market had. Is it going to go up 15%? Or is it going to, which was position, I think it was position 1. And if they're going to go up more than that based on the count, that would be your position 3. So this is required in my opinion. And then after that, the journal is nothing more than an improvement tool. It allows you to identify the issues, and once you identify them and you have your consciousness identify them, they can fizzle out. So the issues that you're facing, a journal has a unique characteristic such that it brings your consciousness to reflect on what you're doing wrong, and what happens as a result of that is what you're doing wrong gets recognized the next time you're about to do it, and it's easier not to do it. So this is the most important tool for improvement, is the journal. Okay, and it uses your mind's ability to identify, or, you know, I think many people have talked about this, but long story short, you get rid of the errors by using a journal. And then finally, if you're day trading, very strongly suggest that you have like a little notepad. It doesn't have to be complicated, it's just a little notepad on the side where it's like a real-time journal. When you're about to do something stupid, this is what's going to stop you. What you do is as you're going through certain thoughts and certain ideas, You write them down. You type them out. It's just in a notepad. And what it does is it basically recognizes your self-sabotage. This is a major issue in trading that it's not really discussed. But one of the key reasons why there's a lack of progress for many traders who've been trading for a long time is self-sabotage. This is not only in trading, but in other areas of life. Your mind can work against you. So what folks don't realize, the mind doesn't always work for you. It works against you. And if you don't, and I'm not going to go into that, but there's a lot of literature that shows that your own, if you've heard of things like limiting beliefs and stuff like that, but basically there's much more to it. All right. So what a real-time journal, which is nothing more than a notepad and just writing out, what it will do is detect errors that you're about to make and prevent you from making them, therefore prevent you from potential tilt, and therefore prevent you from potential major losses, major drawdowns. The way you handle this is you have a real-time journal, because if you try to journal this at the end of the day, chances are you're not even going to remember what you were thinking at that moment in time. You're not going to remember. So the real-time journal will identify errors before they occur, recognize self-sabotage, and also will prevent you from acting on errors in most cases, hopefully. So, let's say you have 3 losses. Your real-time journal will identify, okay, I see this really good trade I'm about to get in, so I can make a lot of money because I had losses now. And your real-time journal is going to say, wait a second, this shit is an error. And then that thought will come to mind, right? And that right there now you can either take that revenge trade or recognize that it is a revenge trade and say, hold on, shut down for the day. So I put all of this together, folks. If you have all these elements, you have the foundation for executing and planning. And that's what trading is. All right, take care, bye.